Thank you very much, and also good afternoon from my side. My name is Tom Husmann. I'm a Senior Equity Product Strategist at BlackRock for iShares. And today we would like to cover navigating the US equity market. And there are a couple of reasons, especially in 2024. So if you think about the headline news, what we see on a daily basis, so artificial intelligence, the Magnificent Seven rallying in the markets, we have also the US election coming up later in the year, and also interest rates. There are many decisions that are to be made that are important to look at and to look at the navigation of the US equity market. What's also quite important to note, also from Beta ETF earlier on the slide, highlighting the majority of the assets are currently in S&P 500 and also MSCI World. Just highlighting again the preference for some of these benchmarks with high US allocations, which we wanted to reflect as well in the presentation, because if we look at the flows in EMEA, a lot of the flows go actually still into US equities and abroad, what we consider core allocations. Today, I would like to cover three different topics. So I would like to start with a quick overview of the trends we are seeing from European investors and how they invest in US equities and some trends we are seeing there. The second point is really deep diving into US equities and overall. So from S&P 500 or MSCI USA, going beyond the Magnificent Seven, what are the different options available in US equities to have more granular and selective views in the markets we are in right now. And then finally as well, what are some of the key considerations when selecting ETFs? Because when we speak to many investors in Europe, there's still a lot of education that we're doing, so it's important to have some of these highlights in mind when looking at ETFs. So starting with the flows and what we've seen in EMEA. So here's an overview of the quarterly US equity flows from European investors since 2015. And we have broken it down to three different categories. So we have broad US, so which is your S&P 500. We have also MSCI USA, so your core allocations. Then we have broad US ESG, so the sustainable alternative of core. And then we have also thirdly precision exposures, which we call the granular exposures from sectors, from factors, and also size, like small caps and mid caps. So the more granular approach. What is quite clear, and when we look at the slide here, is really the trend between 2015 to 2020, and then what's happening afterwards. Because the majority of the flows, as you can see in green, were previously in the broad US equity allocations from S&P 500 and MSCI USA. However, since COVID-19, as you can see here, actually we've seen a lot of more demand for sustainable exposures, but also the granular exposures in blue, where we think about sector allocations, factors, also small caps, to have a very, very granular view. And this is what I wanted to show in a second. Looking also at year-to-date flows, and also since 2023, we've seen again a return to core, a return to S&P 500, given Magnificent Seven, artificial intelligence, and a lot of the performance that is driven by a couple of stocks. And when we also look at sustainable flows, yes, year-to-date in the first few months we had some outflows in the industry, but in Q4 last year we had 17 billion in sustainable. Was actually a record when we think about total flows into sustainable ESG flows in the last quarter. But I wanted to really highlight now the precision exposure, so how clients are actually investing on a more granular perspective. So when they go beyond S&P 500 to have an active view with ETFs. So how clients are more proactively reflecting the views that we have in the markets and use ETFs as a toolkit to reflect these views in the market. A good example is actually going back when it started in 2020. So we had obviously COVID-19, a lot of the companies or like people that worked from home, meaning the tech sector actually started to rally. So a rally in tech sector, seeing some of the flows into sectors, as you can see there in Q2. But then in Q4, we've seen allocations to size, so small caps, so clients with the reopening of the economies are starting to invest more into the local economies, and then also into factors with value companies. companies. So companies that have high value. So US value was in focus. Over time, so looking again at so basically Q3 and 4 in last year, 2023 and 2024, as I mentioned, Magnificent Seven have been dominating the markets. So when we look at the performance of S&P 500 in the last year in 2023 alone, you can see that 26.5% were the weight in the Magnificent Seven, and this weight was actually increasing from 2017, so more increasing by another 10%. But also from a performance contributor, we've seen 65% of the performance contribution in the main index coming from the Magnificent Seven. And here I'm talking about the largest US tech, but also electric vehicle companies that are in the index. What's also very, very relevant and also timely, if we think about the earnings this week. So at the moment, this week alone, we have 178 stocks in S&P 500 reporting their earnings, which is why you see some of the Magnificent rallying again in the last few days, and which is representing 40% of the entire index, and that's in this week alone from the earnings. So again, it is at the forefront from many investors, but the question is, given it's becoming so dominant in the indices, what are some of the other alternatives to invest in US equities to potentially go beyond S&P 500? What we've done to help you from an understanding perspective as well, so we looked into the breakdown, let me see actually if that works now, the equal weight Magnificent Seven on the left-hand side, and we scanned it through a factor lens. So what we've done is we looked at the Magnificent Seven stocks, compared it to all the other different indices in US equities that are often used, to really look at some of the underlyings. And so when you look at the factor profile of the Magnificent Seven, you can see obviously they are expensive, so they have a negative value tilt. They are in high quality in pink. You can also see they have momentum, but at the same time they have a negative small size factor, meaning you have more mega caps, very large companies in there, and they have also negative volatility tilt, so meaning they're actually quite volatile from that perspective. When we compare it to other major indices in the market, including small caps, S&P 500 equal weight, and also MSCI USA value factor, you can see some of the opposite tilting from that perspective. So you can see a higher allocation to small caps and mid caps, including for equal weight, so from a diversification point of view, and you can also see more value as well, which helps clients to really, from an investing point of view, to look at it. We also looked at the overlap of the Magnificent Seven and where it is basically positioned in some of the indices. So some of the indices, for example, value doesn't have any allocation, but then, for example, small caps and mid caps is the same as well. So there are many ways how to potentially navigate what is currently happening in the market. As a next step, I wanted to deep dive into some of these exposures. So starting with equal weight and then also small caps afterwards, and to really highlight what are some of the use cases for an investor and how to potentially build this into portfolios as well. The point one is obviously when we look at holdings and coming back to the largest holdings as S&P 500 and MSCI World often in allocations, S&P 500 or the US allocation is over 70% in MSCI World. So by far, US is the most significant allocation in portfolios. And at the same time, many clients just have one holding, S&P 500. But with that, you will have a significant mega stock overweight and also growth bias in there. And at the same time, you have also a tech overweight at the same time as well. So less diversified. So when we talk about US equity, we also talk about the next step on diversification of the existing allocations, which helps, for example, with S&P 500 equal weight, which has the same stocks, but they're equally weighted, instead of having 26% and over in Magnificent Seven. As a result of equally weighting all the different stocks, you can see the sectors are a lot more diversified, reducing tech, but also increasing some of the defensive sectors. So we have utilities, materials, but also industrials in there, which leads to, from a revenue exposure point of view, to more domestic revenue exposure. So meaning the growth of the US economy is more reflected in some of these revenue exposures that come from the US itself. Compared to S&P 500, where it's actually a lot of international revenue exposure, so from Asia, from Europe as well, which makes it more sensitive as well to global events that are happening in markets. So again, equal weight could be a way to diversify existing S&P 500 allocations from that perspective. That also reduces mega cap and also diversifies with more mid cap and also some of large caps overall. The second exposure, I wanted to also have a bit of a deep dive because it comes really in cycles. There's demand coming very quickly, and then there's a lot of demand, and then it goes. And similar to this point as well, for small caps, we see currently small caps as being undervalued in US equities. So that's one area to potentially look at. If we could think about it, Magnificent Seven that are quite expensive. But some of the use cases, what we also look at for small caps are the domestic exposure. Again, similar to equal weight, where you have a more domestic exposure compared to the standard benchmark, and less to Europe and less to Asia. But then there are also benefits from a selection point of view that can help you to reduce what we consider the total cost of ownership and help you to improve your performance from a securities lending perspective. Because, for example, MSCI USA, the average lending revenues are 2 basis points. Moving to mid caps, they're at around 5 basis points, and then small caps around 10 basis points. So it can help you to offset other costs in the fund through some of the efficiencies that can be achieved through this exposure. So we just talked about the case for US equities, the importance, the weight in portfolios, and also how clients are actually allocating, what are some of the historical trends as well, and what are some of the alternatives potentially to the Magnificent Seven. But I also want to touch point briefly on the selection process. So what are some of the key considerations when selecting ETFs, especially because there are often many ETFs tracking the same benchmark. So what are potentially the points to look at when selecting ETFs. And what we often discuss with clients is really looking beyond the total expense ratio, looking beyond the management fee, because there are many drivers that can influence the costs of the fund, but also the overall efficiency of the ETF itself, which is a main driver for the demand in Europe. And drivers that can basically impact the performance is obviously the replication, as we also heard in a previous conversation, where for US equities, swap replication is possible from an efficiency point of view, but also physical. But then also the domicile, so where are the products domiciled, because there's significant differences between Ireland, Germany, and Luxembourg as well that can have an impact on performance. The management of the funds, but also, the TRs included, and rebalancing. All of this is impacting what we call the tracking difference, so the difference between the ETF and the benchmark, which is what we include as part of the overall efficiency and holding cost of ETFs. So these are important points to look at when selecting ETFs. Another important point as well is in the selection process is the benchmark selection as well. Because when we speak to many clients, often, okay, it's a US equities product, it says what is on the index, but what is actually underneath the exposure that you are buying potentially. So there are potentially intentional exposures, whereas potentially also unknown exposures. So we often also highlight the importance to look beyond, look at the methodologies, the exposures. And one good example here is, for example, S&P 500 and MSCI USA. And here you have the relative performance over time, which highlighted that there was quite a significant performance difference of 4% with a tracking error of over 80 basis points. And the difference here is really just coming from one large electric vehicle company in the US that wasn't included in one of the indices, which obviously could contribute to significant drivers. So net, looking at MSCI USA versus S&P 500, for many clients it looks the same, but it's important to look at underlying drivers to see what exposure you're actually buying. And here we have also many analysis available to highlight some of these points. The same is, for example, for S&P 500 in equal weight, as I mentioned earlier. Same for example, Russell 2000 versus S&P 600 and small caps, to really look what are some of the exposures overall. Just finally, what I also wanted to highlight is really the toolkit. And as it was quite clear in the flows, clients becoming more granular in the selection process. And the question is here really, what toolkit is available, what options are available to go granular. And here we have an overview of the major benchmarks in the market that are tracked by ETFs across S&P, Dow Jones, Nasdaq, MSCI, FTSE Russell for broad equities, but also precision with factors, style, size, and sectors as well, to give clients a very strong and comprehensive toolkit to have an active approach with ETFs by being granular in US equities. So that's from my perspective. So just to summarize again, 2024 and 2023 have been a key year for US equities, significant drivers from Magnificent Seven, and what the question is how to deal with some of the things that are happening in the market with AI, US elections coming up later in the year, Magnificent Seven with the concentration, and also interest rates. So the point is really going a step further to look at some of the other options in navigating really the US markets, given it's such a huge part in portfolios. But that's from my side, and yeah, happy to go later in as well if you want to have a conversation. But yeah, thanks very much.